$200,000 lost in value, 11% wiped out in 12 months. This isn't some future forecast, it's already happening. In 2025, America's hottest housing markets are now turning ice cold. Cities like Miami, Phoenix, and Boise are watching home values collapse faster than buyers can blink. Investor-owned homes are flooding the market, mortgage defaults are ticking up, and in some zip codes, 1 in 3 listings have slashed prices. Incomes aren't rising, but insurance, taxes, and mortgage costs skyrocketing. The result? Buyers gone, sellers panicked, and the bubbles popping one by one. These 10 cities are ground zero for America's next housing implosion. Number 10. Boise, Idaho. Boise was once America's best-kept secret, affordable, scenic, and thriving. But since 2012, the secret got out. From 2012 to 2022, home prices in Boise skyrocketed over 250%, with median prices peaking around $515,000 in mid-2022. That's more than double the national average. Yet, Boise's median household income hovers around just $72,000, creating a dangerously high price-to-income ratio of over 7 to 1, well above the historical healthy range of 3 to 1. During the pandemic, remote workers and Californians flocked to Boise, sending bidding wars into overdrive. In some neighborhoods, investors were gobbling up over 1/3 of listings, driving prices even higher. But in 2024 and into 2025, that momentum has reversed. The number of homes for sale has jumped nearly 60% year over year, while demand has sharply cooled. Many sellers are now cutting prices or offering incentives just to get offers. What's worse, Boise's job market hasn't kept pace with its real estate frenzy. High-paying tech jobs are limited, and many remote workers who once drove the boom are now relocating elsewhere or returning to major cities. Meanwhile, rising mortgage rates near 7% have priced out many local buyers. Monthly payments on a median-priced home in Boise now exceed $3,200, while average rent sits around $1,700, making ownership far less attractive. Price corrections have already begun, with values falling 7% since 2023, and more declines are likely as inventory builds and investor activity retreats. The combination of overvaluation, income mismatch, rising delinquencies, and a softening job market makes Boise a prime candidate for a housing correction. It's a classic bubble setup: skyrocketing prices, weak fundamentals, and now the air is slowly leaking out. Number 9. Austin, Texas. Austin was once the poster child for pandemic-era migration. Between 2020 and 2022, the city saw home values jump over 60%, peaking at a whopping $590,000 for the median home. But by mid-2025, the market has done a complete 180. Prices are falling fast, dropping nearly 9% year over year, and inventory has more than doubled since last summer. What was once a red-hot seller's market has turned into a slow-moving correction zone. The city's tech-driven economy fueled the boom, but recent layoffs at companies like Meta, Amazon, and Tesla have shaken buyer confidence. High-paying jobs that justified the home price inflation are thinning out. At the same time, Austin's cost of living has become unsustainable for many locals. With median household income around $78,000, affording a $3,400 monthly mortgage based on a 7% interest rate for a median-priced home is a stretch, even for dual-income families. Investors who once made up 25 to 30% of buyers in some Austin neighborhoods are now pulling out, and many short-term rentals are being dumped onto the market as Airbnb profits shrink. Rent growth has stalled, and some landlords are slashing prices just to avoid vacancies. In 2025, Austin's housing correction isn't just about rising interest rates. It's about an overextended market that grew too fast for its own fundamentals. Unsold homes are sitting longer, bidding wars are rare, and price reductions are happening in almost every zip code. The housing bubble in Austin is deflating rapidly. Without a massive resurgence in tech hiring or a sudden drop in rates, the city could see an extended market cooldown. For now, it's a buyer's market, but only if you're willing to wait for prices to bottom out. Number 8. Las Vegas, Nevada. Las Vegas has always been a boom and bust city, and in 2025 the bust is setting in. After hitting peak median prices near $475,000 in mid-2022, Las Vegas home values are now down nearly 11% year over year, one of the fastest drops in the country. The desert heat can't stop this market from cooling rapidly. Much of Vegas's growth came from investors and remote workers flocking in during the pandemic. By 2022, investors made up nearly 30% of all home buyers, and thousands of properties were converted into Airbnbs. But now that tourism patterns are stabilizing and the novelty of short-term rentals is wearing off, many of those same investors are selling, and fast. The result? A flood of listings and sharp price cuts. Meanwhile, wages in Las Vegas remain low, with median household income hovering around $64,000, while mortgage payments on a median-priced home still exceed $3,100 at today's interest rates. That mismatch is squeezing local buyers out of the market. Delinquencies are also on the rise, with FHA and VA loan defaults creeping upward, a troubling echo of the 2008 crisis. Another factor? Overbuilding. Home builders rush to meet pandemic-era demand, but many of those homes are now sitting vacant. New home incentives, price discounts, and even buy-down mortgage offers are common as builders scramble to offload inventory. As of mid-2025, the Las Vegas market is clearly in correction mode. Sellers are slashing prices, days on market are rising, and buyer traffic is slowing. And with more interest rate hikes still possible, the pressure isn't easing anytime soon. Las Vegas gambled on non-stop growth, and now the house may be collecting. This bubble isn't bursting all at once, but the air is definitely leaking out. Number 7. Nashville, Tennessee. Nashville's booming popularity turned it into one of the most overvalued markets in the South. From 2015 to 2022, home prices surged nearly 140%, with the median home hitting $465,000. But by mid-2025, that number has dropped over 8%, and the trend isn't slowing. Music City's housing market is rapidly deflating. What drove the boom? A perfect storm of investor demand, out-of-state buyers, and short-term rental speculation. At one point, over 30% of home sales in certain zip codes were investor-driven, pricing many locals out. But now, Airbnb revenues have declined, tourism has plateaued, and many investors are fleeing the scene. Listings once described as vacation rental gold mines are now sitting idle. The price-to-income ratio in Nashville has grown unsustainably wide. With median household income around $70,000, most local families are priced out of a $3,100 monthly mortgage on a median home. That affordability crisis is pushing more people into renting, which ironically isn't much cheaper. Average rent is still around $2,100 a month, though flatlining. Inventory in Nashville has increased by over 50% year over year, and builders are slowing construction or canceling projects altogether. Sellers are now offering closing credits, price cuts, and even appliances to attract offers. Days on market have more than doubled compared to early 2022. Even the city's thriving entertainment and healthcare sectors can't fully insulate it from housing volatility. As mortgage rates stay elevated and buyers get more cautious, Nashville's housing correction looks like it's just beginning. For a city built on crescendos, this one's now hitting some dissonant notes. The Nashville housing bubble is leaking fast, and the chorus of price cuts will only grow louder in 2025. Number 6. Phoenix, Arizona. Phoenix saw one of the wildest real estate rides in the nation. From 2020 to 2022, median home prices soared over 70%, topping out near $480,000. But in 2025, the tide has turned hard. Prices are now down over 9% year over year, and the cracks are deepening across the valley. A flood of pandemic-era buyers and investors, many from California, pushed the market to unsustainable highs. But today, many of those buyers are underwater, quite literally in debt. With mortgage rates hovering around 7%, the monthly cost of owning a typical home now exceeds $3,100, far outpacing Phoenix's median household income of $72,000. Inventory has jumped by more than 55% since last year, and homes are lingering longer. Even newer builds are facing heavy price cuts, as overzealous construction in 2021 to 2022 now leaves developers scrambling to unload unsold units. Builders are offering cash incentives, interest rate buydowns, and even full appliance packages just to close deals. The rental market is also softening. Investors who banked on endless rent increases are facing flat demand, and some are selling their properties after months of vacancy. Meanwhile, distressed sales and price reductions are creeping back into the headlines, reminiscent of Phoenix's 2008 crisis. Despite the city's strong long-term growth, the current market is correcting fast. Zillow and Redfin both project continued price declines through the rest of 2025, especially in outer suburbs like Buckeye and Queen Creek. The sun may always shine in Phoenix, but the real estate forecast is cloudy. Prices went too high, too fast, and now gravity is doing its work. Number 5. Tampa, Florida. Tampa was one of Florida's hottest housing markets, until it wasn't. From 2020 to mid-2022, home prices in Tampa surged over 65%, with median prices peaking near $420,000. But in 2025, the trend is unmistakably downward. Prices have dropped more than 10% year over year, and inventory is rising fast. The market was fueled by remote workers, retirees, and especially investors. By 2022, Tampa had one of the highest investor-to-home buyer ratios in the nation, with 35% of homes purchased by investors in some areas. But now, many of those investors are bailing, particularly as Florida's sky-high home insurance premiums, now averaging $4,200 per year in Tampa, begin to crush profits. Locals are priced out. With median household income around $62,000, affording a mortgage for a $400,000 home at 7% interest means monthly payments over $2,900, not including insurance and taxes. That's nearly 60% of gross monthly income for many families, well above recommended affordability levels. The rental market is also cooling. Rents are leveling off after years of growth, and rental vacancies are increasing, especially in condo-heavy areas like downtown and the Channel District. Meanwhile, builders are offloading inventory with aggressive discounts, contributing to the price slide. High interest rates, soaring insurance costs, and an affordability crunch are all weighing down Tampa's housing market. More than 20% of active listings in 2025 have had price cuts, and buyer traffic has dropped substantially. Tampa's sun-drenched appeal can't mask the numbers. The correction is on, and those who bought at the top are starting to feel the heat. This once booming market may be in for a long, slow cool-down. Number 4. Riverside, California. Riverside, part of the Inland Empire, became California's affordable alternative during the pandemic. Homebuyers priced out of LA poured into this region, pushing median prices in Riverside above $575,000 by 2022. A whopping 80% increase from just 5 years earlier. But in 2025, those gains are reversing fast. Home values are down over 8.5% year over year, and the decline appears far from over. Why the reversal? Because affordability has collapsed. Riverside's median household income is only $70,000, yet monthly mortgage payments on a median home now top $3,700 with 7% interest, more than 60% of income for most buyers. Add in California's rising property taxes and insurance premiums, and many are rethinking their plans to settle here. Inventory is ballooning. Listings are up almost 50% compared to last year, and builders are slashing prices or pausing construction altogether. Some planned communities have been delayed or canceled due to lagging demand. Riverside was also hit hard by speculative buying. Investors and flippers snatched up properties expecting endless appreciation. But rising rates and a slowing LA economy have crushed those expectations. Short-term rental restrictions in nearby cities are also pushing more properties back into the resale market. The commute to LA, once a tolerable trade-off for affordability, now feels less justified as remote work fades and gas prices creep back up. Buyers are hesitant, Sellers are desperate, and the median price has fallen more than $50,000 in the past year alone. Inland California was once seen as the last frontier of affordable homeownership. But in 2025, Riverside is proving that even the cheapest places can become overpriced and overcooked. The correction here is very real, and it's happening fast. Number 3. Salt Lake City, Utah. Salt Lake City's housing market was on fire throughout the 2010s and early 2020s, but 2025 is painting a much colder picture. After home prices soared over 100% between 2015 and 2022, the median home value peaked at around $575,000. Today, those prices are in retreat, down more than 9% year over year, and momentum is still heading south. A major issue is affordability. With median household income around $83,000, buyers now face monthly mortgage payments topping $3,900 at current interest rates, well beyond what most locals can sustain. This has pushed many first-time buyers out of the market, while others have paused purchases entirely, waiting for prices to fall further. Salt Lake's popularity with out-of-state buyers and remote workers helped inflate the bubble. But now that remote work is shrinking and big tech companies have scaled back hiring, the flood of new demand has dried up. Builders, who were rapidly expanding during the boom, are now left with excess inventory and slashing prices on new homes. Investor activity is also falling off a cliff. Properties once purchased for Airbnb or long-term rentals are being sold at losses, especially as rents flatten and vacation travel patterns shift. The city's price-to-rent ratio is now among the highest in the region, an indicator that home prices are wildly out of sync with fundamentals. Active listings are up nearly 60% year over year, and homes are sitting longer, with more than 30% of listings undergoing price cuts. Despite the area's strong long-term potential, the short-term correction is hard to ignore. Salt Lake City's housing market climbed too high, too quickly, and now it's sliding down the other side. 2025 is proving that even mountain markets aren't immune to gravity. Number 2. Charlotte, North Carolina. Charlotte's meteoric housing rise made it a top relocation hotspot. Between 2019 and 2022, home prices jumped nearly 65%, pushing the median home price above $430,000. But in 2025, the boom is rapidly fading. Home values are down over 8.5% year over year, and inventory is swelling across Mecklenburg County. Charlotte's affordability advantage has vanished. With median household income at around $72,000, today's mortgage payments often exceed $3,100 for an average home. That's pushed the price-to-income ratio above 6 to 1, well into bubble territory. Combine that with 7% interest rates, and local buyers are stepping away in droves. Another major red flag? Investor saturation. By 2022, nearly 28% of all homes sold in Charlotte were to investors, especially in fast-growing suburbs like Concord and Gastonia. Now, many of those properties are being dumped back on the market, especially as rent growth has completely stalled and eviction restrictions have lifted. The result? More supply, fewer buyers, and falling prices. Homes are sitting longer, seller incentives are increasing, and price cuts are widespread. Builders are also under pressure, offering steep discounts to clear out new construction before values fall further. Charlotte's rapid population growth helped fuel the demand, but that growth is slowing. Migration from the Northeast and West Coast has tapered, and locals can't afford the inflated prices. Meanwhile, job growth has cooled, especially in finance and logistics, two major local industries. In 2025, Charlotte is experiencing the hangover of its own success. The housing bubble inflated by investor frenzy and in-migration is now unwinding. While the city still has strong fundamentals long-term, this year is all about correction. The bubble isn't bursting in one dramatic pop. It's leaking steadily, and the air is escaping fast. Number 1. Miami, Florida. Miami's housing market in 2025 is looking more like a cautionary tale than a tropical paradise. After peaking in early 2022 with a median home price nearing $600,000, Miami's market has reversed sharply. prices are down over 11% year over year, and the decline is accelerating in areas like Brickell, Wynwood, and even parts of Coral Gables. What caused the bubble? Investor fever. Foreign buyers, crypto millionaires, and Airbnb hopefuls flooded the city during the pandemic, often buying multiple properties with cash. At one point, over 40% of all home purchases were cash deals. But today, even those investors are selling as the numbers no longer make sense. Insurance premiums have become unbearable, averaging over $5,000 per year, while climate risks, including sea level rise and hurricane damage, have driven up costs. On top of that, property taxes are high, and many condos are facing massive special assessments due to new safety regulations after the Surfside collapse. Meanwhile, the local economy is struggling to support inflated home prices. Median household income is just $57,000, yet buyers face monthly mortgage payments north of $4,200. That mismatch is causing sales volume to plunge, while inventory has jumped by more than 60% compared to 2024. Airbnb saturation is another issue. Thousands of short-term rentals are now vacant or underbooked, leading to fire sales and rising foreclosures. Even luxury markets are being hit, with multi-million-dollar condos lingering unsold for months. Miami's real estate party went on too long, and now the hangover is brutal. This is no longer just a cooling market, it's a rapid correction in progress. In 2025, Miami tops the list of America's next housing bubbles, not just because of falling prices, but because the fundamentals never made sense to begin with. And now, the reckoning is here.